Bismillahirrahmanirrahim. So today we are going to continue our discussion of the oral double auction. But first, some general principles. There are facts that we observe in the real world. Like, you see, when we ran the experiment, we saw that some people are calling out that I want to sell my good for 50 rupees, other people. So those are the facts of observation. Now, for complicated reasons which I have discussed at length in other places, and I will not discuss here, there arose a misunderstanding in the West, which continues to this day, that the facts by themselves are enough to reveal the truth. Now, this is emphatically not true. The facts do not reveal the truth. See, for example, think about the experiment. Somebody is observing, here is a sheet, this is what people are doing and saying. So will that reveal what this experiment is about? Not really, because there is a whole hidden background. The facts are a superstructure. Underneath there is an understanding that there is a market structure that we are trying to explore. This is not obvious in the facts. Just the facts, just a picture of what is happening will not reveal. What we are trying to do is we are trying to set up a market. There is in the background a theory which is being tested, which is the supply and demand theory, which is not mentioned anywhere in the facts. So, to understand any set of facts, we must fit into some theoretical framework. That's what the theory is about. Without framework, facts can never be understood. So this is really very opposite of what the West believes. That is, to understand facts, you need a theory. You cannot understand facts by themselves. The same thing is true of experience. It is thought that experience makes you wise, but actually it's not true. The experience has to be interpreted according to some theory. So if you have, there was the King Robert the Bruce, and he had 7 failures in battles against the King of England. So he said, okay, this means that I cannot win, and he was decided that he should stop. Then he saw a spider who was trying to spin a web, and he swung from one side of the branch to the other side of the tree, and he failed and he fell down, and then he tried again, and then he tried again, and so after 8 tries he succeeded. He said, oh. So now in the light of the spider theory, he said that, 7 tries is not enough, I must try 6 tries and 1 more try. And then he called his troops, and he had said that you should go home because we are not going to succeed. Then he said, okay, let's give it 1 more try because this spider. So the facts are the same, but the interpretation is different. This is very important to understand, because in the West they do not understand this. And so this is because of this theory of logical positivism, which is I have discussed. So the positivism, actually what they want to do is they want to have everything be only objective. So when you insert a theory, this is subjective, and they don't want to admit subjectivity into science, but subjectivity is always there. You can't do without subjectivity. So, we can write that 1 over 4 plus 2 over 4 equals 3 equals 4, and this is true and it's a fact, but what does it mean? This is just marks on piece of paper. Unless we understand, we have a whole interpretive scenario. So, when we are observing, every event is completely unique. Nothing like this ever happened before, nothing like this ever happens again. Because the world's history is unique. At time equals x, this event happened. So what does it mean about what will happen at times equals x plus 1? Nothing. At least nothing. So then we need to generalize that fact. We need to see a pattern in it. But pattern is always in the mind. There is no pattern in the facts themselves. The pattern is imposed by the mind. That is the theory. So the theories, our understanding of the world is formed at the intersection of the objective and the subjective. Both of them are necessary. Without the facts, you are spinning theories in a vacuum. These are going to be false. Just the facts by themselves, there is no theory. You can always make a theory consistent with any set of facts. For example, you say, okay, the force of gravity, my theory is that the force of gravity remains exactly the same up until midnight of December 31st, 2000, and then it suddenly will change. So now this theory is perfectly consistent with all the facts of observation. So how can you... So the theories and the facts have to mesh, because the West has worships objectivity and they reject subjectivity. So they cannot admit the possibility that theories are subjective. In fact, every theory that we see is a mixture of the subjective and the objective. You see, for example, there's a very common saying that, just give me the facts. I don't want to know your opinions. Opinions are worthless, but facts are important. So this is not actually true. I mean, facts by themselves mean nothing. So now, there is this theory of supply and demand that is very, very precious to economists, and we are going to discuss why this is so. So, when this theory, for reasons that I cannot explain here, the economists are using what is called the axiomatic deductive method. You start by assumptions that this is how the world works. You never test them. Is this how the world works? So you start with axioms and then use logic to conclude. So we assume full information, zero transaction costs, everyone knows everything, this is how the world works, and so on. And we never test it. So now when the experiments are done, it turns out that nearly all the experiments reject the economic theories, except for this one, the overall double auction. This comes as close as you can to confirming the theory. So actually the way the experiment is conducted, we have made nearly all of the assumptions correct. The buyers, they have precise demand valuations. This may not be true. In general, if you go out to the market to buy things, you don't have a very clear idea of what is the exact price at which you will be willing to purchase something. Sellers have precisely determined costs. Again, this is not always true. You have a complicated manufacturing process. You can't actually determine what the marginal costs are usually. When businessmen are asked what's the marginal cost, they don't really have a clear idea. So, and then we force the students or the subjects of the experiment to maximize profits. We say, this is your score. There can be many other possibilities, and we will discuss some of these other possibilities. So anyway, we have made the experiment setup as close as we can to the demand and supply theoretical assumptions. So now the question is, from the results of the experiment, can we conclude something about the real world? All of these experimental setups, do they hold in some real world situation? Now, so there are two stages where you have to assess, is our theory working in the experiment, and then is the experiment applicable to the real world? And the way that scientific theorizing works is that we have some theory, then we construct an experiment to test the theory if we can. In this case we can. And then we match the results of the theory to the experiment, And if the experiment shows that our theory doesn't work, as it usually does, then we modify the theory and then we conduct a new experiment. And this is an iterative process. A theory is is an idea about how understanding the world. The theories are subjective. This is why, the theory is always a mental construct. This is something, it's always a subjective thing. So there is a continuous debate in West about, are theories true or false? This is a nonsense debate in the sense that theories are always mental constructs. They are never the reality. So theories can never be true or false. A theory is a way of understanding the world. Is this adequate? So it will be in some situations, it will not be. But the theory is a different type of thing from what is happening in the real world. So the supply and demand theory, we have 10 buyers with demands 1 to 10, 10 sellers with supply, costs at 1 to 10. So the theory is very simple. Let's go through the theory. The theory says that, first of all, the theory says that there will be sales at only one price. Immediately we see that our experiment rejects this theory because sales are occurring at multiple prices. Why does the theory say that the sale will occur at one price? Well, because it says that if you are above equilibrium, nobody will buy from you, and if you are below, no one will if you are below, everyone will want to buy. And this doesn't happen because there is not enough information around for the people to be able to calculate the price. So the theory says that there is a price announced, and then we find out what is the demand and what is the supply. And so in this particular example, if we announce the price of 3.5, for example, then at that price there are 3 sellers. No, at 3.5 there are 7 buyers and 3 sellers, because 3 sellers have cost below 3 and all 7 of them have cost above. So it's clear that there will be excess demand, and so this is not an equilibrium price, and with excess demand the buyers will bid up the price, so it will go to 4. At 4 we will now, one of the buyers will drop out, you will have 6 buyers. So this is a theory. It's a sensible theory, but it doesn't apply to this experiment because the experiment doesn't work like that. The key assumption that the way that this theory is made to work is by the Walrasian auctioneer who creates recontracting. He says that, okay, here's the price, tell me what your demand is, and the demanders say, okay, I want to buy at this price. The sellers say, I want to sell at this price. So he matches. If there's a match, then the transaction goes through. If there's no match, then he says, okay, this is cancelled, and we start a new round. So recontracting, the original contract is cancelled, and then this is what allows it to happen. Now actually we can let it happen in the experiment. We can say, okay, let's do it like this. Let's run the experiment exactly like the Walrasian auctioneer would. I announce that this is going to be the price for all transactions. Now how many people want to sell? So some people will raise their hands. How many people want to buy? So if I see that match, I say, okay, you can conduct trade. If I don't see a match, then I say, okay, this price is too high or too low depending on the imbalance, and then I raise it. And if I do it, then we will get a perfect match to the supply and demand theory. So what's the problem? So if I want to create an experiment which replicates the supply and demand outcome, I can do so. So if I did that, why would then I would say, okay, that proves the supply and demand theory. I have run an experiment. In this experiment, I get exactly the same results. So why would people not accept this as a proof of supply and demand? Why not?
Because we take price exogenous.
I say that here I am running an experiment. In this experiment, this is what I will do. I have explained it. I will run it like the Walrasian auctioneer. And when I run the experiment, what do you think I'll find? It's clear. The experiment is set up to prove supply and demand. So I say, okay, here's a proof. The experiments show that supply and demand theory works. Now, what is wrong with this logic?
I wanted to prove something and then I set up the experiment in a way.
Exactly. You see, there's a three correspondences. Does my theory correspond to the experiment? Does the experiment correspond to the real world? So, in the second step, and my theory corresponds perfectly to the experiment. Experiment doesn't correspond to reality. We don't know of any real world markets where there is recontracting. We don't know any place where there is complete revelation of demand and supply. So now we move the experiment one step away from the Walrasian auctioneer and one step closer to reality. Still, we don't know whether this experiment is a match to reality or not, but at least it's not perfectly matched to the assumptions of the theory. So what happens when the buyer and seller bid in our experiment? They don't have information. They don't have full information. They don't know what the demand is. They don't know what the supply is. Do the prices then converge to equilibrium? Should they converge? And why does it matter? All of these are important questions. So what we are trying to do, very important underlying question which is not discussed and which must be discussed to understand why we are doing this, is that we are looking at the theory of value. What are the prices of things? Why are diamonds very empty? Why are diamonds very precious? They have very high prices when they have no value. Why is water very cheap when it is extremely valuable? People would die without water. So, in your own training, you have been trained not to ask the fundamental questions. You don't ask the teacher, why are we studying this? What good will it do? You just ask, is it going to come on the exam or not? That's the only value of the education. So now, what we're trying to do is study the real world. Is this something that will help us to understand the reality that we live in and experience? Standard method is to deceive people by keeping them busy with technicalities and never ask why this technical matter. So this is what Robert Solow said about Lucas, both Nobel Prize winners. Suppose somebody sits down and says that I am Napoleon Bonaparte, then the last thing I want to do is to get involved in a technical, what were your tactics at the Battle of Austerlitz? Then if I do that, then I have accepted his claim, and now I'm proceeding. So Bob Lucas and Tom Sargent like nothing better than to get involved in technical decisions about how to calculate the rational expectation equilibrium in this setup. So once you do that, then you have forgotten that the whole axioms which they have used to get to here are just completely ridiculous. So since I find the whole thing ludicrous, I responded to it by laughing at it, so as to not fall into the trap of taking it seriously. So Lucas says that in response that Solow doesn't try to come to grips with the matter. Romer, who was actually trained by Lucas, is one of the students of Lucas, and he has been giving lot of trouble to students by setting up extremely complicated differential equations and saying that this is what macroeconomics is. So students really get headaches with Romer. And it has nothing to do with reality, his models. So anyway, he has repented partly, and he says that, well, what the macroeconomists say, things which are just inconsistent with the facts. And nobody cares. Economists, he in this article he cites that major economists say that, I'm not aware of any evidence that money matters. I mean, basically the RBC, the real business cycle theory, says that money is neutral in the long run, and in the short run. This is exactly what Keynes says in his book, that money is not neutral in the short run or in the long run. Now there are three positions. There's basically, if you make compromise with Keynes, you say money is neutral in the short run, and not neutral in the short run, but it is in the long run. So in short run, money can cause fluctuations, but in the long run, So what Romer says is that you look at the real world, and you can easily show that money is not neutral, because you show, for example, what he says in his articles, that Walker came to the central bank, Federal Reserve Bank, and then he announced that I'm going to do this, and he took an exogenous action in the monetary policy, and it had an effect. You could see that it caused, he tightened the money supply, it caused a jump in the unemployment, and it caused a reduction in the inflation. So exactly as Keynes predicts, the money had a real effect on the real economy. And so he says that, it's flabbergasting, mind-boggling that somebody who's doing macroeconomics should say that money can be neutral when the data itself is right there. It's like saying that there is no wall over there. When you can see it and you can touch it, and if you try to go through there, you will get blocked. So Keynes had the same problem. In the general theory of employment, interest and money, he says that the long and deep unemployment that followed the Great Depression could not be explained by economic theory, because economic theory says that supply and demand equilibrium will eliminate unemployment. Same thing today. And Nairu, the natural non-accelerating inflation rate of unemployment. So he says that if you try to lower, there is a natural rate of unemployment. If you try to lower it by monetary policy, this will lead to accelerating inflation. This is just wrong. I mean, the data contradicts it. You can prove, there are not just one, many episodes which show that this is not true. You can use monetary policy to reduce unemployment. You can use monetary policy to increase unemployment. Both of these are very solidly documented. So, supply and demand theory does not work in the labor market. This is something, you go through a course in Keynesian economics and you never learn. Students are shocked and baffled, and yet this is exactly what Keynes is saying, but it is never put in this terms, because supply and demand theory is sacred to economists, so they can't tolerate saying that it is wrong. But what Keynes says is that if aggregate demand is not sufficient, then there will be unemployment, which means that supply and demand will not eliminate unless the government takes steps to increase aggregate demand. And now the second main idea of Keynes, which is not acceptable to economists, is that money is not neutral, because basically if you have shortfall in aggregate demand and you pump money into the economy, that increases aggregate demand and brings you to full employment. Now note that full employment is a real thing. If you have less money than required and you have unemployment, you have shortfall in real output. And in fact, if you have shortfall in investment, which also will happen, you will have less investment then the long-term growth path of the economy is affected. You have less capital now, and there's nothing you can do for it to make up for it. So the long-term prospects of the economy will be damaged by bad monetary policies. So money is not neutral in the long run either. So the lack of neutrality of money in the short run and in the long run. In the short run, it will increase employment to full, affect the real economy. In the long run, a good monetary policy will increase productive investment, and it will have a permanent long-term effect. So Keynes says that money is not neutral in the short run and in the long run. But today, leading macroeconomics textbooks hold that money is neutral. Nearly everybody holds that money is neutral in the long run. The short run, there is some difference of opinion. Some macroeconomic theories says that it is neutral in the short run also, like RBC, and other economists say that no, it's not neutral in the short run, but in the long run it is neutral. So basically, Keynes said that professional economists are unmoved by the lack of correspondence between the results of their theory and the facts of observation. This is exactly what Romer is also complaining about. Here is my theory, here is the fact, the two are in contradiction. Oh, something's too bad about the facts. My theory is cannot be changed. Borjas says exactly the same thing. He's writing a Harvard professor, current third edition, very popular labor economics textbook, makes no mention, there's no reference to Keynes. But more recently, Card and Kruger showed that the theory failed, so he says that, it's very surprising why the facts so strongly contradict my theory. There must be something wrong with the facts. Then he goes on to list 5 possibilities. Maybe this is the wrong. Maybe. There's no consideration of the possibility that the theory might be wrong. No, this is not in the picture. There must be something wrong with the facts. What it is, we don't know. So, the same problem that Keynes found 1 century ago persists today. Keynes says that the economists don't accept this conflict between theory and fact. He himself said that I myself believed these theories, and the greatest difficulty in arriving at my general theory was not that the theory is difficult, it was getting rid of these preconceptions. So he succeeded in getting rid of, cleaning his mind, but he could not make his fellow economists follow. So the Samuelson-Hicks interpretation of Keynes is actually, which is known as Keynesian economics, has nothing to do with Keynes actually. So here's a quote from Borjas, Labor Economics. We don't fully understand why recent evidence differs so sharply from the simple and sensible supply and demand framework is soundly rejected by data. But one reason why this is so is, and then he goes on to list a number of excuses, all of which have been actually examined and rejected by Card and Kruger. Because Card and Kruger's book, Myth of Measurement, says that supply and demand framework is rejected. So then lots of people objected, and then they have written a article later in which they say, okay, here's somebody said this is wrong for this reason, somebody said this. I mean, people have been trying to reject their results, but not successfully. So then we come to the bigger question. Why do economists use theories? Why can't they modify the theory? Well, like a normal person would. Okay, here's my theory, is soundly rejected by the facts. Let's make a new theory. Why reject the facts? There are many jokes about economists which show that everybody understands this problem. Like there's this famous joke about the people who fell from a plane and they are stranded in a desert, and there is 1 can of food. So the geologist goes and looks for rock formations to try to find something which can open the can because they don't have a can opener. And the engineer looks for some levers, and the chemist looks for something else. But the economist, he just assumes it's open and eats it. So why do economists use this kind of theory which is so strongly contrary? In 70 years this keeps on going. I mean, this so at some point you should understand that your theory doesn't work and try to modify it, but no. So this is a very complicated question, and there are many dimensions in the answer, but one answer is that economists are using a wrong methodology. They are using axiomatic deductive methodology. So the question, I've explained this in my lecture on Islamic origins of the scientific method, and I have said that basically science was imported into the West from Islamic civilization, and although science was very well understood and advanced, the methodology of science, why it works, was not understood. So the first one to try to understand science was Francis Bacon, and he said that it's based on induction. What is induction? Induction is basically you look at a collection of facts and then you try to deduce a law on that basis. The other way to do construct theory is axiomatic deductive. You start with certain truths and then you use logic to construct inferences. That's like Euclidean geometry. So you have the parallel postulate and you have this, that and the other. Both of these are actually wrong understanding of science. Neither the axiomatic deductive nor the inductive is a correct understanding. And I have explained some of the problem in this paper, methodological mistakes and econometric consequences. Now the econometrics is based on the inductive understanding of science. It says that you look at a pattern in the data and you assume that it will continue, and so you project. This is how you run regressions. Now this is simply wrong. I mean, lots of patterns exist up to a certain point, and then there is a structural break, like the global financial crisis occurs and every pattern breaks down. So this is not how science works, by looking at patterns and extrapolating the pattern. But this is how econometrics work, and that's why econometrics leads to wrong results all the time. So the methodology of economics was constructed on the basis of this logical positivist philosophy, which is seriously flawed. It emerged in 1920s and 30s and was rejected in 50s. But economics, the foundations of economics were constructed in the 30s, and they have not been changed even though positivism has been rejected. So what positivism was basically the underlying impulse. You see, there's the surface, what it says, what the facts are, and then there's what's underneath the surface. So logical positivism was invented explicitly, specifically, to prove that science leads to the truth and religion is just superstition. So the obvious way to do this is to say that, well, everything unseen cannot be, there is no proof for anything which cannot be seen. Okay, you can believe in God and you can not believe, but this is something which is not scientific. So when they rejected unobservables, then they also rejected theories. They said, okay, facts, what we can observe is all there is there. That there is facts have to be fit into some hypothetical theory which is made by our mind. This was not acceptable, because if they accepted this, then there would be no difference between science and religion. Basically, the science, so there's a serious problem that science also looks at the facts and then deduces something hidden, like the existence of electrons or gravity. These are all unobservables. So now logical positivism used very sophisticated, complex philosophical maneuvers to get around this problem that the science also depends on unobservables. These maneuvers were later found to be defective. They don't work. Basically what positivists said was that you take any unobservable terms and you can replace it by its observable equivalents. So, for example, I say that there is gravity. Well, gravity is unobservable. They say, okay, when we say gravity, this is just shorthand for talking about the elliptical orbits, which is what is implied by gravity. The same maneuver is used in economics. You see, I have preferences in my heart, but this is unobservable. So, but my choices are observable. So replace the preferences by the choices. This was the positivist maneuver. Now, this turned out to be a mistake. You can't make that replacement. I mean, you have to have the preference in the heart. You can't take this out of the picture. But this mistake has not been accepted by economists. So now, why is the axiomatic deductive method used? Well, basically, in economics, basically this is the only way to achieve certainty. If you use induction, there is no guarantee that it will be true. You look at a pattern, but the pattern is imposed by the mind. And there are many different patterns in any given set of data. Given any set of n points, you can fit arbitrarily many curves through that point. So every curve is a theory which fits all the data. So there are always multiple theories which are compatible with any given finite collection of data. So you cannot. So the facts do not lead to a specific theory. So the only way to get certainty, and this is what the philosophers wanted. They wanted to prove science is certain, and then they wanted to prove, and depends only on the facts. They don't want to have science depend on subjective matters, because then it will not be certain. So, but once you use this axiomatic deductive method, then you start with certainty and you use logic, and there is never any intersection with reality except in the framing of the axioms. If you make the wrong axioms, then you can get anything you like. Now, the one connection with reality is that the axiom should be true. Now, this connection was also broken because Friedman said, and many other philosophers said, that your axioms need not be true. Why shouldn't they be true? Well, you say our models are not the reality. The map is not the terrain. A model has to simplify, so our axioms simplify. So now you see you have a methodology which is completely free floating. You start with axioms which need not be true, and then you never check the implications of the facts against implications of axioms against facts. See, this is the correct methodology, that you can start with simplified axioms, and that's what I'm going to try to teach you, how to build models which are useful. So you start with simple facts, oversimplify, because the axioms are not a reflection of the reality. They are a reflection of your attempt to understand reality. So they are things you simplify the world, and then you see, even if the world is simple like this, will it give the same results? So then you look at the results and you match, and if you find that it's a good match, then you say, okay, this is a satisfactory model. I can understand the world using this model. But if they don't match, then you modify the axioms. Now, the economists don't check. They don't check it for correspondence between the results of their model and the reality. Because they say, okay, we start with certainty and then we use logic, so we can never get to a false result. If there is a problem with the match, there must be something wrong with the facts, because our methodology is perfect. Because they mix up two things. There is the axioms. If the axioms are certain, then certainly it is true that the results will also be true. But if the axioms are wrong, then the results will be wrong. So they mix up a couple of things. So basically, the models that we use are mental and subjective structures within our minds, which create a replica of reality, which we can understand and manipulate, because we can't understand and manipulate reality, but we can understand the models. So a model is like the picture on the retina of our eyes. It is constructed by a reflection. It's a reflection of the objective reality, but it is simplified. There are many things out there which our eye doesn't pick up. The image on the eye is a two-dimensional image. The reality is three-dimensional. So obviously, the image, but it is factual. It is a reflection of the facts. But at the same time, the the way we see the world is that we look at this reflection, which is the model, and then we interpret it according to the rules. It's not just the facts. It is not just the image that we see. It is the image interpreted by the mind. A most amazing experiment which shows this is that you put reversing glasses on people. These reversing glasses invert the world, so the ceiling looks like the floor and the floor looks like the ceiling. The people get dizzy. But after a while, if they keep these on, then their mind adjusts, and then suddenly the mind learns to interpret this image, and so suddenly the world looks right side up again. The mind learns how to interpret the image. And then if you take them off, then the world looks upside down to them. So this shows that how we see the world is based on both the model and the interpretation of the model that is taking place. So just like that, the reality is too complex for us to grasp. It's three-dimensional, we can only have two-dimensional understanding. So we make simple models, and then we ask, is this good enough? So the good enough will be in the context. It is never the case. The question, is the image in the retina an exact replica of reality? Is it true? It just doesn't make any sense. This is a different thing and that is a different thing. You don't even ask that question. These are different types of things. But you ask, is it good enough for us to navigate? So yes, we can walk around in the world. We don't run into things, so it's good enough. But it's not always good enough. There are some well-known problems with this image and interpretation. The mirage in the desert is an optic, and there are many other optical illusions. Our mind uses clues to interpret the reality. Sometimes these clues can be misleading. So here is a simple optical illusion. It seems very obvious to us that the upper line is longer and the lower line is shorter. This is what our eyes are showing us, because there is a clue that we use to interpret length. It is not directly the image. In the image, the two lines are perfectly identical in length, but our eyes are not showing this. So this is because the interpretive apparatus in the mind is very strong. Similarly, when you look at train tracks, they look like they are converging, in fact, when they are completely parallel. So this is to explain what models are. The models are always a combination of a representation of reality with an interpretation. So it's always subjective plus objective. This is something which the West doesn't accept, and that's why they don't understand what models are. So now what I'm saying is something, there is a natural question that arises, that I'm saying that the West doesn't understand what science is. Well, obviously they are the only ones who are doing science. The Islamic civilization hasn't been doing science for a long time. So so how can they make fantastic scientific progress without understanding science? Well, basically scientists learn science like apprentices. They don't learn methodology. It's just like, you see, the language, the best users of the language don't have any understanding of grammar. Grammar is the rules of language which other people study. The grammarians are not the ones who are experts in literature, and the experts, the best writers, are not grammarians. The rules they know instinctively. So the methodology of science is something which people who study scientists ask. How is it that scientists are getting good results? They try to understand what the scientists do, and they make up rules. Just like the grammarians study how people use language and they try to find out rules. But these are not necessarily the rules by which the language operates. So the methodology of science was studied by philosophers. Francis Bacon never did any science. He was just trying to understand this new thing which had been imported into the West from from the Islamic Spain, and it worked very well, and it was contrary to the tradition, which was axiomatic deductive. He was trying to find out how this thing worked, and he made a theory about it. The scientists were just following the method without trying to understand why it works. So the main people who developed philosophy of science were not scientists, and the scientists did not pay any attention to what it is that they were supposed to be doing. They just followed the practice, just like you can learn how to drive without understanding what the engine of the car is like. Now, so this methodology of science, this was harmless, yani people studying what scientists do, but there was a problem that arose, that social science was developed in the West as a replacement for religion. They said, okay, religion, our religion, Catholic religion, is wrong, and so we need to understand how to construct society, how should people behave, all of these things which religion tells them what to do. They said, okay, we reject religion, so now there's a vacuum. What is good, what is bad, what is moral, what is the code of conduct for human beings, should we have families or should we have affairs? All of these things are questions which religion answers and to which science doesn't provide any answers. So that, okay, science is tremendously good, it has been very powerful and useful, so let's follow the methodology of science in order to construct social science. Now, the problem is that the methodology was then used, but the methodology that they understood, which was positivist, was wrong. So the methodology caused a great deal of damage to social science because it was explicitly said, okay, let's try to do what the scientists are doing. So that is why the misunderstanding of the methodology of science did not do any harm to science in the West, but it did a great deal of damage to social science in the West, because social science attempted to adopt the methodology of science because they were starting from vacuum. They said, okay, we know nothing, like, Descartes, he says, I don't even know if I exist or not, because so he said, okay, let's see why I can create a proof for my existence. I think, therefore I am. Now, this effort to construct social science failed completely. The idea was to use facts and logic only, without using revelation and without using the heart and the soul. See, if I want to say, do I exist or not? So, I just close my eyes and reflect. I can sense the blood flowing in my veins. I can sense my heart pumping. I can feel my emotions. I mean, I don't need to think about thinking. Even when I wake up and I have no thoughts, except that, Alhamdulillah, I'm alive. I can feel that I am alive. So, I don't need to think. So now, but they said, okay, let's construct social science on the basis of facts and logic. So now, where are the facts? Where is the logic? This is something which is a feeling in my heart. You can't see it. It's not objective. So then they had to construct a logical proof. Now this effort failed completely. It's because they have cut the heart and the soul out of human beings that today we see massive problems. Families are being destroyed, communities are destroyed, all of the things which are human are being destroyed because they don't lead to money. That's the only thing that you can see. So the disastrous impact of this misfounded social science is increasing and continues every day. So, with this general background, let me come back to the question that we are dealing with. These are all so basically what we see is that prices converge to supply and demand equilibrium in oral double auctions. So the question is, Why does this happen? Can we say from this? See, we are working in three stages. I have this theory, I have this experiment which does not match exactly the conditions of the theory, and then there is reality. So we are looking at the correspondence between our theory and the experiment, and then also we need to look at the match between the experiment and reality at a later stage. So now what the economists would like to say, and this is actually being said in some of the articles that we will look at, that look, even though the assumptions of supply and demand don't hold in the oral double auction, still we get convergence to equilibrium, and therefore we have proven that supply and demand works. This is a very bad way to understand what is going on. First of all, we can say that the oral double auction rejects supply and demand theory. We can say that supply and demand is proven wrong by the oral double auction. The fact that it converges, or whether or not it converges, doesn't matter. But just because one prediction of theory is matched by observations, this doesn't prove that the theory is right. There may be hundreds of other theories, and in fact we will construct other theories which are better matched to explain what is going on in oral double auction. They also predict the convergence to equilibrium. So if theory X and theory Y both predict convergence to equilibrium, and they are different theories, then both cannot be true. So just the fact that the theory predicts the outcome correctly is not a proof that the theory is true. In fact, once we understand that theories are unobservable, theories are about unobservables, then you come to the standard discovery of Karl Popper that theories can never be proven true, because theories are always an addition of a subjective element, and they are always about unobservable elements, like what is in the heart. So these theories can never be proven. All you have is confirmation that, okay, the oral double auction seems to provide some confirmation for the supply and demand theory. That's all you can say. You cannot talk about proof. So what really is true is that the trouble is that the economists are trained in ways that makes them utterly clueless about the way the world works. Economists think that the world works by magic. So an example of magical thinking is that supply and demand model makes predictions about the real world. None of the assumptions are satisfied, but by magic it will produce the right results. You see, let's think just about the oral double auction. Now, according to what does the supply and demand model say? Well, I'll consider that a little bit later. To show that supply and demand doesn't work in the oral double auction, because it's just magical thinking. And so what I need to do in this course is to teach you how to make models correctly so that you can avoid magical thinking and make good models. So, contrary to the way that you have been trained, models are really involved. Models are an imposition by our mind on reality. So the first thing you have to do is you have to understand what the reality is, and you have to have some understanding. It is this understanding of yours, this mental, subjective understanding, that you translate into formal terms. That is what becomes a model. So in creating a model, you think about the phenomena that you're observing, and you try to isolate that in this phenomena, I think these things are important and they matter, and I need to take them into the model. And I think that those other factors are not important. For example, we might say that, okay, I'm going to construct this supply and demand experiment. Technically, everything matters. Who the person is, how he was, where he was born, what was his upbringing, what are the courses he has taken, everything matters, technically. But we say probably it doesn't matter. All people are sufficiently alike that we can ignore all of this background. However, this may not be true. If the experiments that we run reveal that there are differences, maybe there are two types of people in the world. Some people are inherently generous, some people are inherently stingy. So then in that case we would run, if we wanted to run an experiment and we found out that this matters, then we would take a psychological test before running the experiment, classify people into two categories and say, okay, now we have, and as a matter of fact, in this experiment we know that experience matters. So we asked people that, have you played this game before? Do you understand this game? And so if the people are experienced, they get different results, and the people are not experienced, they get different types of results. So the people matter, and this is contrary to economic theory assumptions. Economic theory assumption says that every time you play a market game, it will always lead to the same result. But now, if we learn from experiments that experience matters, then we can differentiate markets. We can look at a stock market and we can say, okay, this is a new market, and the trade, this just launched recently, people don't have much experience, so we will expect to see different types of phenomena here. And in an experienced market, for example, we will study later on markets with bubbles. We find that inexperienced traders can create bubbles and experienced traders do not in that market. So if this is actually true, then we can look at the stock market and we can say, okay, maybe the bubble was created because a lot of new people came into the market and purchased stocks for the first time, and this was maybe something that was encouraged. So that would be an explanation. Now, according to the standard supply and demand theory, rational expectations pharma theory, this cannot happen. The prices reveal the true value of the stock and they cannot deviate, because what happens is that if the price goes above equilibrium, then the experienced traders will see that this is above equilibrium and it will go back to equilibrium, so they will grab the opportunity, and by doing so they will drive the market towards equilibrium. But in reality what happens is the opposite. Instead of the experienced traders exploit the inexperienced ones to create bubbles and make profit at their expense. So this is one factor which experiments reveal, which is not part of the standard theory. So basically, when you run experiments, you learn things about the real world and you use this to modify theories. This is contrary to the economics methodology, which just uses axioms and logic. So basically, this is how science progresses. We make a model, we try to see if there is a match between our model and what the results of the experiments are showing. If the experiment shows significant deviations, then we think about what is missing in our model, which is causing these causing these deviations, and then we change the model, and then we check it again, and we keep iterating this process. We keep improving the model to achieve a better match to reality. But in economics, this doesn't happen. There are two types. There are things which happen. Sometimes, what Kuhn says is that there is normal science. You take the model and you tinker with it a little to try to make it give the results which match. But sometimes, like the Ptolemaic theory of the universe said that the planets always travel in circles. So now, as the data kept accumulating, you find that the orbits are elliptical. So you say, okay, we have epicycles. There is one circle, but then there is another circle on top of this circle, and so the planets follow these two circles. And then the fact kept accumulating, and two circles were not enough to match, so they built three circles. And they had a fairly good match to the data. And this is exactly how science works. You start with a model. If it's too simple, then you make it more complicated, and then you make it more complicated. But ultimately, people say, well, this is so complicated, it cannot be a good description of reality. So let's start over again. So that's called a paradigm shift. And so basically, you go to the elliptical orbits, which were discovered by Muslims, by the way, not Kepler. And so then you discover this, that, okay, the elliptical orbit theory provides a better description than the more complicated Ptolemaic story. So this is how modeling process works. All right, so we come to the description of the oral double auction, and we see that the equilibrium price is 420 in this sequence of experiments, which were replicated 5 times with identical conditions. And you see that in experiment 1, you have fairly wide deviations away from the equilibrium price. The efficiency, which is basically there is a 100% surplus. If all trades take place at equilibrium price, then you maximize the trader surplus, you maximize the buyer surplus for the consumer surplus. We will discuss these concepts a little bit more later. So you calculate the buyer surplus and the consumer the seller surplus, and you add them up, and you find that 95% of the total surplus available in the market is captured. In the second experiment, only 91% was captured, but in third, fourth, and fifth, you get to nearly 100% efficiency. You have 5 trades, 5 trades, 5 trades, 6 trades, and 5 trades out of a total of 10. So you're not getting full trading. Alpha, I've forgotten what that is. Deviation.
I think so.
Yes.
From the mean price. Or
Deviation from the mean price. So deviations are going down, and basically we are getting that as the trading periods go on, you get convergence to equilibrium. Well, it seems that way anyway. So this is the data, but now what does this data tell us? So the very important thing to understand, again, which I must emphasize, is not understood by the West. The data doesn't tell us anything. You have to add some interpretation. So, for example, we are very eager to prove supply and demand, then you can say that the data proves supply and demand theory is true, because we are getting convergence to equilibrium. But this is a very bad way to interpret the data, as we will see. You could say that the data clearly rejects S&D because there is no equilibrium price, and the trade takes place at multiple prices and always occurs at prices above equilibrium. Now the economists might say, well, the difference is small. Well, that's a subjective matter. What is small and what is large? All right, so this, because there is such a strong misunderstanding about the relation between models and reality, I have a lot of lectures and material on it, which we have covered in our previous lecture, so I won't go through it again, but I have provided some links. So, there is a whole book by Abdul Karim Sadriye, The Alternating Double Auction Market, a game theoretic and experimental investigation. So the key question in the oral double auction is, why is there convergence to equilibrium? How does it happen? What is the learning process? See, basically what we are saying is that there is the data does seem to show that there is convergence. There is not complete convergence, but certainly the variations go down. So why are the variations going down? What is it? What is the mechanism by which people are learning, if they are learning? Certainly, so how do the players interact with each other? This is what leads to convergence. So there are two elements of the thing that we need to understand. Two elements of the experiment. One is the institutional structure, how the thing is structured. So this Abul Karim Sadriye, the alternating double auction model, is the one that we used, and we will use other variants later. The original double auction market, the oral double auction, is just people standing in the room and they are shouting their offers to buy and their bids for the bids to buy and the offer to sell. So these are at random. People just shout out, and there is no sequencing. So here we created what is an alternation. First the sellers get to bid, then the buyers get to bid. Even this is not very realistic. In the markets, what we have is something which is called posted prices, and that's a better. Posted prices means that the sellers get to post that here is my price, and the buyers get to choose. The buyers don't bid. So in that situation, here, because the oral double auction, the buyers are bidding, so we get idea about the demand curve, and also we get an idea about the supply curve. So there is the best possible chance. But this doesn't really replicate reality. So in any case, the question is, if there is convergence, why does it take place? This is not explained by supply and demand. That is the magic, the magic of markets. That automatically we create a market and magically it converges to equilibrium. This is ridiculous. This is not a theory of how the game works. Doesn't give us an explanation. I am looking at the intro from this book, Abdul Karim Sadriye, which I don't recommend for you to read. I have read many books and many articles of 10 books. This is a subject is new to me. I haven't studied oral double auction before, and so I'm learning it for the first time. And I give the students only one article out of 10 to read. So this book says that there are two good reasons why the game theoretic equilibrium of double auction has not been scrutinized. The game is extremely complex and the game is not properly specified. Game properly specified means that what are the moves, what are the options? So this has to be written out very clearly to create a game tree. If everybody is standing and anybody can shout at any time, then there is it's very difficult to construct what is the branch of the tree, what are your options, and what are the things that. So that's why he says, the first move the sellers will make, and one of them will be chosen as the standing offer. Then the buyers will either accept the offer or they will make a counter bid, and so on. Now, Sadriya says that only one person has done this, and that's Wilson. The Wilson paper creates a model which is a continuous time model in which people are deciding on their bid, the sellers are deciding on their offers. So now in that Wilson model, what's happened, I want to explain this. Wilson model is wrong, but I want to explain why it is wrong. So basically the Wilson model says that everybody looks at your own, the sellers look at their cost and then they make a bid which is in line with their costs, and the buyers look at their values and they make a bid in line with their values. Not the value, of course. That is actually called, just to have a convenient name, there is the truth-telling strategy. everybody, if you have a cost, you announce that this is my cost and that's what I'm prepared to buy it. So you want zero surplus, and the buyers announce this is my value. So you just tell the truth about what your cost is and what your value is. So if bidding was like that, then the highest bidder would trade with the lowest cost. That is the first transaction that would take place. And then those two would go out of the market. Then the second transaction would take place with the second highest value bidder and the second lowest cost. And this would continue in this way until we get to the 5, which is the equilibrium, that is called the marginal unit. The marginal unit is the one with the cost 5, at which exactly one buyer has value 510 and one seller has cost 490 in your experiment, and they will trade with each other. After that, there is no further trades. The buyer with the cost 600, this is called the extra marginal unit. This unit should not sell in the market because there should be only 5 sales, and the marginal unit is 500, the infra-marginal, the sub-marginal unit is 400, and the extra marginal is 600. 600 should never sell. And this is exactly what the Wilson model predicts, that the trades will take in sequence, placed in sequence, and the highest value will trade with the lowest cost first, and then the second highest value will go. Now, when you run the ORL double action, this does not happen. So, this theory is rejected by the experiment. And in fact, quite often what happens is that people with extra margin, like the 600 cost trader, will be able to sell his unit because he jumps in early. And if the equilibrium was true, then the 600 cost would never sell. So basically, Abul Karim Sadriye is trying to find a game theoretic model which can be solved. This is a very important thing that is a constraint on how economists model. They can construct very complicated models, but they can't solve them. So then those models are no good. So they try to create models which can be solved, and that's why the Sadriye model, he makes a lot of assumptions about, one of the crucial assumptions is that of complete information. See, if you want to be able to calculate what is your correct strategy, then you need information. Suppose okay, I'm here playing in this ORL double auction, and I know nothing about this game except that I have a cost. The cost of my unit is 400. I don't know about what the other costs are. I don't know what the buyer values are. So how can I make a move in this game? I should offer. Suppose that all of the buyers have values of 3,000. So then my unit costs 400. I should be able to bid 1,500. But I don't know anything. So how can I make an opening bid in this game? So there is no, yet of course human beings operate all the time in environments where nothing is known, and then they explore the environment. So this exploration cannot be understood within a game theoretic framework. Actually it can be, but it requires a massively complex setup, because then I have to construct all possible states of the world which might exist, and then I have to give priors over this. And this is not how people behave anyway. So he says, okay, let's assume that people know, I know all the costs and I know all the values. So this assumption of complete information. More than that, that's not enough. I need to know how other people will be behaving, so I assume common knowledge. Not only do I know, but I assume that everybody else also knows. If that is true, then you can construct what is called the Bayesian Nash equilibrium. So when you start to solve this model using standard game theory, you get to this necessity of making false assumptions. And basically, okay, so the whole book develops this model in which there is a game and in which you make assumptions about knowledge which are not true and are known to be not true, and then you solve the game. Why? Because that's the only way you can solve the game. If you don't make these assumptions, then the game cannot be solved. So exactly like this, the models that are being used by economists are the ones that can be solved, and if they make the model correspond to reality, then they can solve them. So that's a dilemma that they have, which we don't have. All right, so as a result of this, this is the conclusion, two main results of the book, Abul Karim Sadriye, that convergence to market clearing price is driven by a simple success control mechanism as postulated by the learning direction theory. So actually, this is all we need to know from the book, these two sentences, because the model itself is worthless, it has no match to reality. But he says, okay, in that model, the result that comes out is that there is a learning mechanism which the agents use. What is this learning mechanism? Well, if they are successful, then they follow up on that successful strategy. If the strategy doesn't work, then they change the strategy. And the second important thing is that there is an anchoring price. This is a behavioral effect. The first person to speak, he creates an anchor, and then people adjust within that parameter. So these are the two things that we need to understand. Okay, even though the first person to speak will name an arbitrary number, because the person doesn't know, am I an extra marginal trader? Am I the person who has the cheapest cost? Am I the person who has the most expensive cost among the sellers? He doesn't know. So anybody can speak. And so the guess will be wild, and he doesn't know how much the buyers have. So, but whatever he speaks, that will create an anchor, and the other people will then respond to this. So these are two things we need to keep in mind when we try to construct better models. Now, one of the things that you read in your variant is that we are committed to equilibrium. Krugman says that I am an optimization, maximization, and equilibrium type of guy. So we construct equilibrium and then we study the equilibria. So this is wrong, as we have explained many times. We need to understand what happens in disequilibrium. This is exactly what's happening. I mean, what we are trying to do in studying the oral double auction is to understand how the disequilibrium changes to equilibrium. And about this, S&D theory gives us no clue. Actually, S&D theory does have a theory, but that theory is wrong, as we will study soon. So here is a situation in which there are three equilibria. The equilibria number 3 is actually the type of equilibrium which economists like. This is the type of equilibrium which, if it was true, then the economist methodology would work. Because basically it's a very strong equilibrium. If you move away from it, you will be quickly pushed back to it. So in that case, we can ignore disequilibrium and not be too far wrong. But 2 is also an equilibrium. It's at the equilibrium at the top of the wheel. If you're exactly there, you will stay there. But even the slightest push will will move you away. So this is what's called an unstable equilibrium, locally unstable equilibrium. So it's locally unstable, and so you won't expect to see it in the real world, because even the slightest disturbance will move you away. So how do we know? Well, you can't know about whether the equilibrium is stable or not by just the equilibrium. You need to know what happens at a nearby point. When you are in disequilibrium, near this equilibrium, what are the forces which act on the model? But to do that, you have to study what happens in disequilibrium in order to understand what are the forces which are acting on this ball when you are in disequilibrium, only then can you find out whether this will move towards equilibrium or whether it will move away from equilibrium. And then equilibrium type 1 is a locally stable equilibrium. For small pushes, you will come back to it. But if you get a big push, you can move from this equilibrium to another equilibrium. So these three are different types of equilibrium. You also have situations like you have a flat surface. So if you have a flat surface, the equilibrium is a small push will move you away, but it will not be a catastrophic move. It will just move a little bit. So basically, the economic methodology of studying equilibrium only blinds you to the reality. You cannot understand what is going on. So, when we want to build a model of what is happening in the oral double auction, as a first step towards understanding what is happening in a more complex reality, then we have to understand what is the process which is taking place in this game. We have to construct a mental model. Now, this is easy to do because we are human beings and we are not mathematicians. You play this game and you understand how humans behave. Humans beings do not calculate the solutions to differential equations in order to find out how they will play. So if you want to model the game, you have to think about how humans behave. If you understand, and you should play the game to get some experience, to understand how people will behave in this game. If you run the experiment as experimenters, then also you will get some understanding of how people behave in this game, if you are successful in explaining how the game works. So, no math is needed. You have to find out what are the rules of behavior. And if you can write down those rules, that's it. Now, what I'm saying is that I'm going to try to teach you agent-based modeling. In agent-based modeling, all you need to be able to do is to write down the rules of behavior that the people will follow in this experiment. That's all. Once you have that, then you feed this to the computer, because you can't calculate, because there are two things which will happen. You have the rules of behavior. Those are the things about which you have intuition. Then there is the institutional structure, which is, of course, under our control. So that we also is part of the model, that we make an institutional structure which we think is a good reflection of reality. And then how does this rule of behavior interact with the institutions? That is a complex thing. Different people will be acting according to different rules. There will be heterogeneity. So now we put all of this into the computer, and then we let the computer solve. And Maaz has been struggling with programming this in ABM for a week or so, and I think he has gotten somewhere. And I'm not actually going to be teaching agent-based modeling in the sense of teaching the nitty-gritty details of the programming. I'm just going to give an overview. But I would recommend and advise that you learn NetLogo and learn this programming, because you need to do this for your thesis if you want to do a thesis. And these are the most exciting theses that are available at this time, because we can take anything like supply and demand, it's just your basic, and we can show that the conventional theory is wrong, and then we can try to develop alternatives, and these alternatives will be developed by using experiments to understand what is going on, and then agent-based modeling to try to distill this understanding into simple frameworks. So our models are very different from the economist model. The economist model is one which can be solved by hand with pencil and paper. The models that we think are going to be useful are, the economy is too complex, so you can't write down one or two equations and solve them. You have to write down 300 equations. Even a macro model, which Klein model was, which was based on very simple assumptions, had more than 300 equations. So you can't solve them by your hand. You can solve them by the computer. We can do more complex things. We can make 1 million agents and give each of them a different behavior, and then we ask the computer to solve, and the computers can solve these models now. So it is possible for us to create models which were impossible. And in fact, the older generation of economists doesn't even know that such models can be made, because you see, if you say that in my model I have 1 million agents, then you automatically say, well, this model is impossible, because see, the model cannot be solved. So our understanding of models is different, because we understand the elements of the model. We don't know how to solve the model, but that's no problem. We ask the computer to do it for us. So there are two things which happen which the computer can do, which it is hard for us to do. One is the institutional structure and the social norms which govern the interactions. And these lead to outcomes. You see, you can understand every single person, but what happens in the interaction, this is called a complex system. The interaction can lead to unexpected outcomes. Happens quite often. For example, everyone wants to have higher income. But in the system as a whole, this cannot happen if you are looking for higher income relative to the average. So everyone pursues an illusion. For every individual, this is possible. He can increase his income relative to the average. But for the group as a whole, it is not possible. So, in fact, this leads to what is called the rat race. Everybody looks at your level of happiness is governed by your position relative to the average. So everybody thinks that they can improve their position relative to the average, and everybody works hard all their life to get above average, and then since everybody is working, so the average level also rises, so you are end up nowhere. So the solution to this rat race is to prevent people from competing in this way. That way they won't waste their effort on an illusion. Similar thing happens in monetary theory. The quantity of money is fixed. Everybody wants to increase their savings. So people withdraw money from the circulation and put it in their banks. This leads to reduced aggregate demand, and it decreases. So basically the money holdings don't change, but the aggregate demand declines, reduction occurs in output and in prices. So the system effects are very different from what is happening at the individual level. So main things which are different in our approach is that we will be studying disequilibrium. Now disequilibrium is very complicated. That's why people haven't studied it. And so the solution to the complexity is that we will use computers to solve our models instead of solving them by pencil and paper. The second difference is that human behavior is not maximizing behavior. As we have seen in this ODA game, the maximizing behavior is impossible because people don't have the information required to do maximizing behavior. So what the economists do is they assume everybody has enough information to allow for maximization. So this assumption is wrong and doesn't actually capture reality, and we can make better assumptions. So generally human beings, because maximization is impossible, they use satisficing. If I have my cost, and if I can get more than my cost, and there is some margin like 10% or 20% I want, okay, so maybe I can make $1 million in profit. It's not, that's not how people behave. People say, okay, this is what I want, and if I can get that, I am satisfied. So this non-maximizing behavior is necessary because the maximization behavior requires an enormous and impossible amount of knowledge, but satisficing behavior can be done in uncertain environments. So this is a more satisfactory assumption. And finally, there is complexity. Even though we understand what every individual is doing, we may not be able to understand how the system behaves because the complexity of interactions, and so that we allow the computer to tell us, and then we try to understand it. This is also part of that how does this complex outcome occurs. So a model is a mental representation of a complex reality. Now the thing is that so we start with an understanding. Now our understanding is usually not coherent. We may have different types of beliefs about the world. For example, you might believe that, okay, monopolist will charge the maximum, extract the maximum price. But we also see that people will resist this behavior. And so we think that people will not buy if somebody is being exploitative. So now these two things are not compatible. So we try to create a model in which we put down our insights and we try to make them cohere with each other. In this process, we get to a more sharp understanding of our own inner mental state. So writing a model is an exercise in self-understanding and in articulation and in self-expression. Can I write down what is a jumbled up understanding in a very clear way and give instructions? So basically, one way of articulating is that write down the rules of behavior that you follow in the oral double action. Instead of writing down, so suppose that instead you are going to play in the oral double and you want to win, but you are not allowed to participate, you can only give instructions. So you write down instructions to the person who is going to play on your behalf and say, okay, in this situation do this, in that situation do that. So when you do that, that creates a model of agent behavior. And that is the thing that we want. So we know about alternating ODA. So all sellers write down the asks, all buyers write down their bids. Now what happens next? That's an institutional structure. What I can do is I can take these and I can just match them. That's an institutional structure. In fact, this is what happens. If you go to the housing office in Colombia, people come from all around and they say, okay, I have my house and this is what I want to rent for. Students come in and say, I would like to rent a house or an apartment or a room. So the housing office says, well, what is the price that you're willing to pay? So they say, I can pay up to $500. They say, okay, we have these 4 or 5 houses in this range. So you can go and look at them. So they are actually matching. They are not doing, but what in the oral double action, what the structure adopted is that I take all of the bids and then I look at the minimum. I take all of the offers to sell and I look at the minimum and say, okay, so and so has made the minimum offer. He is the standing seller. On the bidder side, I take the maximum bid for purchase and I say, okay, he is the standing buyer. And then there is a second step. There is another way which is the game is played. This is also institutionalized. Okay, I say I put these two together, that you are the one with the minimum cost and you are the one with the highest offer. You go and talk to each other. Maybe you can work out a deal. So they go and talk to each other, and if they can work out a deal in some midpoint or at the buyer's offer, then they conclude and they are taken out of the market, and maybe they cannot work out a deal. So he says, no, I won't, this is my final offer, and he says, this is my final offer. So they say, okay, you go back to the pool, and then we run the experiment again. Everybody writes down the offer, and everybody writes down bid, but this time people have information that the last time this was the offer and this was the bid, and it did not conclude, or it did conclude. So now the next round you have more information. So this way, this is a third institutional structure which is different from the first two. So the outcome depends on precisely how the institution is structured. If it's a posted bid, different outcomes as a result. If it is oral double auction, different auction. If it's alternating, it's different result. So from immediately we understand that supply and demand model doesn't work because it doesn't give different results for different institutional structures. All right, so basically I'm going to end here. That there are many considerations. One of the things is that supply demand makes a very specific prediction. It says that if somebody offers a price which is below equilibrium, everybody will want to buy from him. This is not true. People, when the first bid is made, people don't know whether it's above equilibrium or below. So nobody knows whether everybody should go there or not. Similarly, it says that there will be only one equilibrium price. It also says that it also gives you a mechanism. Actually, it gives you a mechanism. It says that initially there will be a price, there will be too many buyers, people will realize that this price is too low, and the price will rise towards equilibrium. So basically it says that if you are away from equilibrium, you will converge to equilibrium. So if you look at the pattern of prices, you find that it doesn't happen that way. You can have a low price, then it below equilibrium, it can shoot to above equilibrium, and so on. So none of the predictions about how the disequilibrium changes to equilibrium is true for the supply and demand. So you can basically reject that. The supply and demand model does not give us any useful information about how to think about oral double auction. This is a very important thing to understand. Contrary to what is being said in the literature, contrary to what economists believe, that okay, the ODA confirms the supply and demand model, the ODA model completely rejects. The SND is completely irrelevant. Now, having thrown out this model, then we can think about what are good models to explain what happens in ODA, and that's the next order of business. Now, what I would like you to do is to conduct this experiment once again, and try to make sure that you understand what is going on. There's a lot of material explaining how this experiment is conducted and what are the results to expect. I want you to be able to replicate what is going on in the book. So I want you to learn how to do experiments, because we are going to do a lot of them. And it is much better for you as PhD students to learn how to do these, because these will be useful to you later in your writing your thesis. All right, so that's all for today. Thank you.